Today's market moves weren't just about rising prices, they reflected a quiet but important shift in how investors are thinking about rates, inflation, and what really matters for this rally. U.S. equities moved higher again. The S&P 500 gained around 0.8%, the Nasdaq outperformed with a 1.3% rise, and the Dow followed behind. But the more important move happened beneath the surface. Yields fell sharply. The 10-year Treasury dropped, easing financial conditions. At the same time, oil pulled back, reversing earlier spikes tied to geopolitical tension. Gold, interestingly, still moved higher, suggesting some investors are not fully letting go of hedging behavior. Volatility declined. Crypto moved higher, and leadership concentrated heavily in technology and materials. So on the surface, this looked like a clean risk-on day. But what changed wasn't just sentiment, it was expectations. The key shift came from oil. As tensions around the Middle East showed signs of stabilizing, oil prices dropped, and oil right now is acting like a pressure valve for the entire macro environment. When oil rises, markets worry about inflation and tighter policy. When oil falls, that pressure eases, and that's exactly what we saw today. As oil declined, inflation expectations softened. That allowed yields to fall. And once yields fall, something important happens. The valuation of long-duration assets, especially technology stocks, expands. So this wasn't just optimism, it was a repricing of the discount rate. At the same time, earnings continue to hold up. Across sectors, companies are still delivering solid results. That reinforces the idea that growth is stable, not collapsing, even with higher rates in the background. And layered on top of that is the AI story. Semiconductors and large-cap tech continue to attract capital, not just because of momentum, but because companies are actively investing, aggressively, to capture that growth, even to the point of raising debt to fund AI infrastructure. That tells you something about how serious this cycle is. So when you put it all together, capital flowed very clearly today. Money moved into growth, into technology, into anything sensitive to lower yields. Energy lagged as oil fell, financials didn't benefit much despite the rate move, and defensive sectors stayed relatively flat. This wasn't broad risk-taking, it was targeted positioning. Investors are rotating away from inflation protection and back toward growth and duration. But this is where things get more fragile, because the current rally depends on a few conditions holding at the same time. First, yields need to stay contained. If they move higher again, the same valuation support driving tech higher can reverse quickly. Second, the AI trade is becoming crowded. Capital is concentrating into a narrow group of names and themes, and while the long-term story may be strong, the short-term positioning increases the risk of sharp reversals if expectations aren't met. Third, geopolitical risk hasn't disappeared. Oil fell today, but the underlying tensions haven't been resolved. Any disruption could quickly bring inflation concerns back into focus. And finally, there's a growing divergence. Equities are rising while yields are falling, which is supportive but also somewhat delicate. It suggests markets are pricing an ideal scenario: stable growth, controlled inflation, and no policy shock. The question is how stable that assumption really is. One debate investors are having right now is whether this shift toward AI-driven growth optimism is sustainable, or if it's becoming too dependent on perfect conditions. I'd be curious how you see it. Is this a healthy repricing of growth, or the early signs of crowding risk building beneath the surface? Looking ahead, several things could test this narrative. Labor market data will matter. Strong employment supports earnings, but could push yields back up. Inflation data becomes critical. Any upside surprise could challenge the idea that inflation is under control. Big tech earnings and AI spending updates will also be closely watched. Markets are assuming these investments will deliver. And of course, geopolitics, especially anything that impacts oil, remains a key variable. So the story here isn't just that markets are rising, it's that markets are increasingly shifting away from macro fear and toward earnings confidence and AI-driven growth. The broader takeaway from today's reaction is that this rally is being supported less by improving fundamentals and more by falling yields and concentrated growth expectations. That creates opportunity, but also a layer of fragility, because if either rates or expectations around AI begin to shift, the current balance could change quickly. Markets rarely move on a single narrative, so I'd be interested to hear how you're interpreting today's signals. If you find this kind of calm, analytical breakdown useful, consider subscribing. I share regular briefings focused on the deeper forces shaping market behavior. And as always, thank you for spending a few minutes here.